My whole trading changed forever when I understood exactly how to trade supply and demand. So in this video, I'm going to be going over an entire breakdown of exactly how to find and pinpoint your entries using both supply and demand areas. So everything I do comes down to the simple triple X model. I trade with one fair value gap, I look for one entry, and I use one confirmation model every single day. And it all comes down to a simple line or rectangle of support or resistance, right? So if you're struggling with psychology or you need a simple edge you can execute mechanically and repeatably every day without letting your emotions get in the way, then this video is going to be for you. So when you're approaching the markets, what you need to understand is that I use a 4-pillar approach every single day. And so this 4-pillar approach will require you to understand a couple of things, right? Where is the structural lows and where are the structural highs? So I always start off by understanding the market structure. And so to give traders some more context on this, right? We had a structural high over here, then we had a pullback, and then from here we had a structural high over here. So there is my breaker structure, right? So nice and simple, we have a structural break. And so the way that I want to, understand this is that we have, a high producing over here, we had a low, then we broke this high over here. Perfect. That is the first step to, understanding any market. Now, once we have that, what we're looking for is, if I just replay price a little bit, right? I'm going to be going over a little bit of a price action case study review. I want all the traders on the S&P 500 to go and review. This is the 7th of August. So once you have that in place, we want to understand our dealing range. And so our dealing range is the most recent low to the most recent high. And so the way that I like to explain this to traders is that all of this is internal structure. You need to understand where the most recent high and low is, so you can then understand the premium and discount, and then you want to be choosing the right fair value gap. And so this video is going to be dedicated towards choosing the right fair value gap. So let's just kind of mark this out. So we have this structural low down here and we have this structural high up here. So this is our dealing range. So anything in between this dealing range is indeed internal structure, and you really want to be ignoring the internal structure, right? It's just noise. You want to ignore the internal structure, right? So that is step number one. So I'm just going to mark this out. Step number one is structure or market structure. Step number two is the dealing range, right? So step number two is the dealing range. So what is the dealing range? The dealing range is what I just showed you, right? It is the most recent low to the most recent high, just like that, right? Just from here to here. Most recent low to the most recent high, right? What is step number three? Step number three is PD arrays. And so the PD arrays, or the premium and discount arrays, simply represent two sections of the dealing range, right? It represents the discount and the premium, right? So look at how I've done that. The fib tool is used and abused by almost every trader I've seen, right? So if you're not using premium and discount to understand where your fair value gaps are, you're not really trading. You're a chartist. You're somebody who uses the fib tool to think you are trading instead of using the fib tool to understand how to trade. They're two different things, right? Using the fib tool as a chartist and understanding when to trade with the fib tool are two different things, right? So make sure you get this right. Now that we have the premium and discount arrays over here, so anything above the 50 is a premium, anything below the discount, we're looking for 15-minute fair value gaps. And specifically, I'm going to be breaking down a buy trade you could have taken last week, or how to use the 4-pillar approach. So the 4-pillar approach is now, number 4 is fair value gap. I'm just going to write FVGs for short, right? So fair value gaps are essentially imbalances, inefficiencies, right? So by using the 4-pillar approach, what you've derived is POI selection. POI selection. And so POI selection is the bread and butter to how I trade, right? So you may have heard me talk about the triple X model. So the POI selection is where to trade from. Then you need to know what to look for, right? Which is basically buyers and sellers. And then you need to know why the markets move up and down, right? So the number of traders who don't know why the market moves up, in this case, we're going to be going over a buy trade. Why does the market move up? And more importantly, why are you pressing the buy button, right? What gives you confidence to press that buy button? We're going to break this all down. So let's kind of break this down. So we have POI selection over here. So how do you form a POI? Nice and simple. So now notice how this is the 50% area. We're below the 50%. So we've come into a discount. And so how do I form my POI? So I want every trader to understand what a fair value gap is. And so this here is essentially the fair value gap, right? So the fair value gap in this case is, you can see this wick, right? And this wick, there's a gap there, right? If you look at in between the red lines, there is a gap. And so my point of interest is always the last candle before the fair value gap. Always, right? It is just going to be this candle over here. Boom. Right? So I'm going to get rid of the red lines because I don't really like them there. It's a bit confusing. This is the point of interest, and a point of interest is derived from two things. When you're choosing a POI, right, a point of interest or a POI is derived from two things. You need to know, so I'm just going to put this over here, right? So this is our point of interest. You need to know that a point of interest is essentially needs to be priced correctly. So if you're buying, your POI needs to be in the discount, and on top of that, it has to leave a fair value gap. These are the two things. Now, the third extra confluence you can use, and we're going to be going over this, is what we call PO3 alignment. PO3 alignment, right? So I didn't spell that right. So we're going to be using PO3, right? PO3 alignment. What does that mean? So let's kind of drag this over to the right-hand side. So when price comes into this POI, and that's what we're going to be breaking down now, right? So as price comes into this POI, we are going to be understanding why the market moved up. So a couple of things to understand. Whoa. A couple of things to understand here is, okay, number one, we're in the discount, right? That's the first thing. We're in the discount. And we've tapped into a fair value gap, right? We've mitigated that fair value gap on the 15-minute, which was in and around this region, right? Notice how we have a 5-minute fair value gap here as well. So yes, do I use 15-minute fair value gaps? I prefer using 15-minute fair value gaps over 5-minute fair value gaps, but you can use 5-minute fair value gaps if you want. So now that we've tapped into this 5-minute fair value gap, right? We want to understand something called PO3 alignment. So what does a PO3 alignment mean, right? So can you use the daily PO3? Can you use the 4-hour PO3? Well, the truth is you can use either depending on what you prefer. There's no right or wrong answer to this. So what we can see is we can see that this was the high of the day, right? So let me just draw that again. This was the high of the day, right? The daily opening price was here. This line's a bit faint when I'm drawing it out. So we can see the market moved up and then the market moved down. So now we're below the daily opening price. If you're below the daily opening price, what you want to understand is that the market is most likely going to give you the highest probability returns when you are taking a buy trade below the daily opening price. Okay, so when you're trading below the daily opening price, you want to be looking out for a few things, right? You want to understand this, right? You want to stack confluences in your favor, right? So we have a discount, we've tapped into a fair value gap, and on top of that, we are below the daily opening price. So we're below the daily opening price. So I'm just going to write here DOP. We are below the daily opening price. Perfect. Now, for those who are a little bit more astute with the PO3, for those who understand the PO3 a little bit more, we're going to be breaking down the 4-hour PO3, right? So the 4-hour PO3 will look like this. So you want to untick New York midnight opening price, and I'm going to show that again. This is where the PO3, again, it's the same exact concept, right? So this is the PO3 opening at 2 p.m. Eastern, right? This is at 2 p.m. Eastern. So when you're at 2 p.m. Eastern, this is the candle opening price at 2 p.m. Eastern. So I'm just going to put a red line. And so how does this actually work? So this candle will open, price will go higher, price will go lower, and we're going to tap into a key level, right? So KL. So we want to be looking for a buy trade below this candle's opening price. And this is fundamentally how the power of three works. The power of three, accumulation, manipulation, and distribution, right? The key thing that traders miss is the manipulation. Catching the manipulation essentially means you are catching the low of the candle. This is the manipulation. If the markets want to move higher, the markets will move lower to go higher. This is the whole concept of a manipulation. So I'm just going to break that down one more time. You want to be using the manipulation with order flow. And we're going to come on to what that means. So let me just break this down. The markets will open, we'll have some accumulation. We're going to be focusing on the manipulation, right? And then, of course, that helps you catch the distribution. But realistically, we are looking for the manipulation, right? This here is the manipulation, right? This is the manipulation right here. So in yellow, we're looking for the low of the candle. So this, if you can calculate or if you can predict where the low of the candle is going to form, this will increase the odds of your buy trade working out, right? So you don't want to be FOMOing into positions, right? So let me give traders a few tips. First of all, you do not want to be entering anywhere here. So you do not want to be entering anywhere here. My advice to traders is you don't want to be entering at the first wick. So if you enter at the first wick, you're most likely going to take a loss, right? This is an unnecessary loss.
you can miss. Now, the two ways you can prevent the loss from happening is just by analyzing your key level in a bit more detail. We had a 5-minute FVG over here. We can see price has basically filled the entire FVG. So you want to avoid losses on the first tab. So my advice to traders is to understand not to trade the first tab, right? So this is where we build psychology, we build patience, right? FOMO is for traders who don't backtest enough. FOMO is for traders who don't understand how the market works at key levels, right? We want to be buying below the candle's opening price inside of a key level, right? This blue box is the key level. This gray box is also the key level. So how are we doing that? So what we're doing now is we're looking for a change in the state of delivery. So how do you spot a change in the state of delivery? So ICT talks about CISD, right? Talks about change in state of delivery. So how do you find that, right? There's a few ways to do it. So let's just give you a little quiz here. Is it going to be market structure? Is it going to be an inverse FVG like I see some traders, using? I see a lot of traders using inverse fair value gaps. Or is it going to be something else, right? Is it going to be order flow? Or is it going to be whatever it is, a market structure shift, right? As some people, or if I've already done market structure shift, is it going to be, I guess, the 2022 model, which I think is a market structure shift and a fair value gap, right? So you want to forget that. You want to forget this. You want to forget this because these are patterns, right? You are a sophisticated charting gambler if you don't know what's going on. You also want to forget ICT, right? What does a change in the state of delivery actually mean? It means that in this case, buyers have stepped in, buyers are in control. And so how are we going to figure that out, right? All you need to know is, are buyers in control, right? Once you come into a key level, are buyers in control? Are sellers in control? And the way this works is if you see buyers in control, you want to buy. If you see that sellers are in control, you want to sell. So in this case, buyers were indeed in control. And so how can we calculate this? How can we figure this out? So I'm just going to clear the screens up, right? Knowing if buyers are in control comes down to using the order flow. And so ICT can be boiled down to a few things. You are basically trading off a fair value gap. You want to have some kind of a PO3 alignment, and then you're trading order flow. So these are the three things that will make any ICT trader profitable. So if you're unprofitable, you want to just figure out which one of these steps you're missing, right? Are you trading without alignment, right? Are you trading without the PO3? Are you not waiting for price to come below the candle's opening price? Are you not identifying your fair value gaps and your key levels correctly? Or are you gambling on patterns? Are you not using order flow? So it's going to be one of the three things. So if you're a losing trader, just address which of those three things you are. But for those who want to win, this is how you do it. So we're looking for ideally a change in the state of delivery, right? We're looking for some kind of a change in the state. So let's just go down to the 1 minute time frame. So on the 1 minute, we're seeing a shift in fair value gaps, right? So we're understanding bullish fair value. In this case, bullish fair value gaps are being respected, right? We saw that on 2 occasions over here. So how can you take this trade, right? How can you be confident in this particular trade? So this is where the footprint charts come in. And so the footprint charts, so I'm going to stress one thing. This chart you see here is exactly the same as the chart you see over here. These two are exactly the same. So let me get them side by side. So what you are essentially seeing, or what you are looking at here, is the low of this entire range. So you're seeing this price action over here. So let's kind of dive in. So this is a microscopic view of the charts. This is the microscopic view of the charts. So you're looking at essentially this kind of wick and this bottom wick. So you're looking at this and you're looking at this. So what do you see over here, right? 465 for 218, right? 301 for 4. Now, the left number represents the bid. This is the aggressive sellers, right? The right number represents the ask. Those are aggressive buyers, right? Same with 301 for 4. So 301 for 4 means there's a significantly more aggressive sellers than buyers. So what that means is that sellers are aggressive, right? So at this price, so on ES, this was around whatever price point this was. So I'm just going to label the price point. Right, so the price point here was around 63. Oh, let me change that. So 63.33. Right, so this was the price point, 63.33. And this was the price point over here, 63.39, 63.40, right? So 63.40 was just over here, right? 63.40. So when you've seen these two, right? When you've seen these two prices showing us the actual price action, what that's showing us is that at the price point 63.33, we see a lot of aggressive sellers hitting the bid. Now, the reason I know there's so many aggressive sellers, you can't see it through the candlestick charts, but when you look at the order flow, you're beginning to see the fact that we see lots of red delta. So when you do the left number minus the right number, if that number is, if that number, sorry, is bigger than zero, so in this case, 465 for 218, 301 for 4, we see the bid is way bigger than the ask. So we're seeing at 63.33, aggressive sellers hitting the bid. Now, you want to ask yourself from a common sense perspective, right? In this region, we can see aggressive sellers failing. So what this means is we can see aggressive sellers failing. This means at this price point, who is in control? Who is in control at that price point? Well, it's not the sellers. It's not those aggressive sellers. So what's happening to all the aggressive sellers at 63.33? They've been absorbed. And this is the one concept I want every trader to understand, right? So in this pattern, in this price action over here, there's no pattern or liquidity sweep or any fib tool that can help you understand who is in control. So if you don't know which fair value gap you're trading from and you don't know what to look for, good luck finding the trades, right? It's very, very difficult to explain this in any other way. And it's quite simple once you get it, but order flow is an art, just like most other things. It takes practice, takes time, takes diligence, takes a few mistakes, but they're worth it. So having a precise read of fair value gaps at the key levels is what will set you apart. So you're looking at 465 for 218, 301 for 4, and then you see the finished auctions, right? You see a finished auction here, 7 for 0, 54 for 0. You see two zeros. Again, this is at 63.33. So it's showing you the auctions have been wiped out. It is showing you buyers aren't even present, which shows you the auction has been wiped out. There's no actual trading there between the buyers and the sellers. And this is what shows us that buyers are actually in control because all these aggressive sellers failed. So what this shows us is that at 63.33, there is actually passive buyers. And these are going in with, this is what's important. They're going in with limit orders, right? There are buy limit orders resting in this zone. So all of these aggressive sellers failed, which means that limit orders, buy limit orders are present. And that is a secret behind trading ICT in the first place, right? So once you understand that, you can take a buy, a long position from here, right? And you can have your stop loss below here because you know there's a finished auction, right? You know the price action is finished trading here. You see a zero, which indicates the market is likely to reverse. And so now let's quickly break down 63.40. It's the same concept as 63.40, right? So if we just kind of bring this down, at 63.40, we see more absorption, right? So at 63.40, we see 1, 2, 3, and then we see a massive breakup. So what happened to the sellers here, here, and here, right? 58 for 100, 58 for 11. 58 aggressive sellers, and there were no aggressive buyers, which shows you there's an absorption of all these sellers as the market broke higher. So I personally wouldn't have taken the first trade. I want to see the retest. And so this is what a retest entry looks like. Price comes into the level, we see the absorption, and then price breaks above. Then we see the retest, we see another absorption, and then we want to enter here, right? So how would I have taken this trade? I don't trade the PM session much, but I would have entered here in this case. I personally preferred my entry to be around here with my stop loss. You can either have it here if you want, or if you prefer wider stop losses like me, you can have it here. And so this is what a break and retest essentially looks like, right? So a break and retest in this case, buyers are in control here, buyers are in control. Sellers in this case have been absorbed. I'm just going to write AB, right? The sellers have been absorbed. So it shows you here, sellers have failed, buyers are in control, they drive price higher. And so this is the bread and butter of ICT concepts, right? So if you're an ICT trader and you're struggling, it's probably because you're trading patterns instead of understanding how the market works. So with that being said, let's just jump up to the 5 minute. And the next question becomes, well, where do you target, right? So this trade had a lot of scope to 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 basically target for, right? So the last concept I'm going to finish on is this, right? If we just look at this from a 15-minute time frame perspective, right? What we can see is we can see the following. This is market structure basics. We can see price giving a high, a low, a high. We've had a retracement, and then we see the markets moving higher. So what's happened is this high created this low, and this low created this high. So you want to ask yourself, has this high created a low, right? Just stop and pause, right? Has this high created a low? This low has created a high. This is a strong structure. It's done its job. Has this high created a low? Well, it hasn't, right? It's not broken any structure. So what you want to understand is we want to target weak structures, ones that have failed to break the previous high. So once you've understood this, you can begin to understand that this trade had massive scope to the upside. And the reason it had massive scope was simply because the markets actually failed to break the previous low, right? So this high up here was your overall target. So this trade had a lot of runway, right? So let's just go back to the actual trade itself. So how would I enter this trade? I would look for a break above and I'd have my stop loss comfortably below this level because I know sellers have failed at this region. So now it's a waiting game. So if we just go back to the 5-minute, you can see this trade had massive scope, right? This trade itself, a lot of scope, right? So if we just allow price to do its thing, we can see the markets moving in our overall favor, right? And the reason why, again, is because buyers were in control, right? Buyers were in control in this region, right? So let's just see how this happened, right? Let's just play this on. Again, very, very large trade to the upside.